If a government shutdown won't stop stock bulls, what will? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Peter Boockvar, the CIO of Bleakley Financial Group and the author of the Boock Report on Substack. Hey, Peter, it's great to have you back on.
Thanks for having me, Maggie.
And hey to everyone who's joining us live on Substack and YouTube. As always, put your questions, comments in the chats, and we'll get to as many as we can. And if you are not on Substack and subscribing to us, please come do so. You can find information for both the Market House and the Boock Report in the description. So really interesting day, Peter. If we look at the market action, the U.S. government shut down, but stock investors took it in stride. The S&P hit a new record high, which I think surprised some people. The NASDAQ advanced. But then you have these conflicting headlines because gold also hit a new high, and you read like, oh, they're sort of at a pullback on risk and a little bit of safe haven buying because of concerns about the shutdown. So, how are you looking at this market action?
A lot of interesting dynamics. My thought on the shutdown, after being in this business long enough to see a bunch of them, is outside of the life's guarantees of death and taxes, is the guarantee that the government, after shutting down, will reopen.
Yeah.
And whether it's 10 days or 20 days or 30 days will depend on the polls, because the polls will determine who caves. But I can guarantee that the government will reopen with probably very little consequence in the context of a $30 trillion economy. I think that's why the market's yawning. We're sort of desensitized to this political nonsense. And for every federal worker that's furloughed, they'll get back pay. And yes, there'll be some missed experiences. You can't repeat if you miss going out for dinner because you didn't get your paycheck. You can't make that up. But I think generally speaking, I don't expect it to last long. I don't think it's going to have much of an impact, and I think the market is telling us that. I think the market's dealing with much bigger priorities in terms of the AI tech trade, what's going on with the consumer, the economy, rates, the Fed, and so on.
Yeah. Let's get into some of that. And we did see bond yields move a little bit lower too. So we're not going to get unless this is resolved quickly, the monthly payroll number, but we are getting private payrolls. And I know you look across a slew of economic data and earnings, reports and what CEOs are saying. So what's happening with the economy? What are you seeing?
Well, I think I've said so many times, probably here and written about how mixed and uneven the economy is. I keep using those terms, but that's to me the best description. We know the area of the economy that's rocking and rolling, and that's obviously anything related to or touching the AI data center infrastructure build out. The numbers are just astonishing, and seemingly every day we wake up to another deal being struck with some provider and a new data center that's getting built. And the monstrosity of these buildings are hard to comprehend. Then we know also the upper income consumer, particularly benefiting from the rise in the stock market, their spending behavior has still been pretty robust. But on the other hand, the stress on the lower to middle income consumer continues to gain, I think, greater attention. And we've seen that just over the past couple of weeks on the subprime auto space, whether it's tricolor. Now that could be fraud, that could be sort of double counting collateral and particular issues there. But and of course they were lending money to undocumented immigrants and so on. But it's also, when you read about that, it's also a symptom of the free flowing money that's flowed into private credit. I think I get 10 emails a day offering me some private credit deal. And yeah, there's some good underwriters that will be just fine in any down cycle. But when you have too much money chasing too few good deals, there are plenty of deals out there, but there aren't as many good deals. There's going to be poor underwriting, and we're going to suffer the consequences of that. Then there's First Brands. Then there's CarMax talking about a rise in loan loss provisions last week in their earnings call. You had a Wall Street firm talking about rising delinquencies at Upstart. So these are the things that I think we need to pay attention to, and to just further expand on how mixed the economy is. We got the ISM manufacturing number today, below 50 again. Pace of existing home sales, which may get a lift with this drop in mortgage rates, but they're still hovering around 30-year lows. Global trade, relatively muted. I mean, looked at the August trade data on the good side that came out last week, and you look at imports and export data, and you had one of the slowest monthly numbers that we've seen in a while.
Mm.
And outside of that capital spending party going on in Gen AI, it's relatively muted otherwise. And I recommend to the viewers here, also getting back to the ISM, is to read the comment section because it's still littered with a lot of stress that businesses are experiencing in response to the tariffs.
Mm.
There's this belief that tariffs are fine if they don't generate higher inflation, and somehow inflation up or down is the test. Well, I argue that the 2018, because I hear that argument, well, in 2018, tariffs didn't cause inflation, therefore they were fine. Well, instead they caused a manufacturing recession. And what they've done this time around is prolong a manufacturing recession that we were already almost 2 years into and well into that now. So again, circling back, a mixed and uneven economy that is what I'm seeing here.
Yeah, and mixed and uneven is it's problematic for a few reasons. So it's interesting what you're talking about in terms of this uneven economy. Some people call it the K economy. If everything's chugging along and earnings stay strong, I guess you could say, well, okay, we have a bifurcated economy, so what? But at some point, the people who are on the lower part of that K are not going to tolerate this forever, right? There are sort of political implications of that, aren't there?
Well, for sure, no doubt. And but also on the upside of the K, the upper end of the income spectrum, the entire U.S. economy right now is betting on this AI trade.
Mm.
If the first half of 2025 saw average GDP growth of 1.6%, if you take out all the data center infrastructure spend, GDP growth was basically flat. So the U.S. economy, the U.S. stock market is basically all in on this trade. And it's sort of domino-esque in a sense that the trade itself is driving these stocks to incredible, eye-popping market caps. Those stocks are dominating the indexes that those that own equities have piled into. And that level of wealth creation that we've seen up to this point is then in turn driving consumer spending, where the top 10% are spending basically half of all the money on things. So everything rides on that tech trade sustaining itself and that build out continuing on. Now, we know eventually it stops. The hope is that other things maybe can offset that or cushion that, but I don't know if that's going to be the case. And no amount of Fed rate cuts are going to cushion the blow when that spending slows down, because that spending, the cost of capital is not a binding constraint on that spending currently. And therefore, when that spending wants to stop, lower rates are not going to lift it again. Mm-hmm. So, and in a way, like OpenAI, for example, is too big to fail within this ecosystem because of the extraordinary amount of financial promises they've made to NVIDIA, mm-hmm. to Oracle, to all these other CoreWeave, to all these other companies. So it is a cycle that is just going on and can continue to, but we know how it'll eventually end. It's just when that will be, I don't know. But it's incredible how the whole market and the economy is tied up into this one capital spending binge.
Yeah. And there's some really important things that you said in there. And, one of the things that are knee-jerk response when people say it looks like a bubble or it feels like the .com bubble. And, that is that people are like, no, it's not the same because AI is so transformative. And by the way, Emma, some fantastic comments. If I have time, I'll read a couple of them that Emma, who works in the space, is making about just how quickly these things are moving and how much compute power she's using working on them. But that can all be true. And many believe it is. I mean, we're sort of seeing it. But what you're talking about is something else. First of all, it sounds like all of that capital that's being sent, is that sort of pulling capital from other places or other projects that might be getting it? Is it sort of hoovering up all the capital out there?
Well, it's I don't want to say all. I think it's the outside of the capital spending on that. Like I said, the economy is very sluggish outside of that one sector. So, and tariffs and there's a Richmond Fed survey did in conjunction with Duke University of CFOs for Q3, and I think it was 25% of companies surveyed are slowing their CapEx plans because of tariffs.
Mm.
You know, when you have rising costs due to higher taxes, which tariffs are, you will have less free cash flow to invest in other things. And let's take some of the semiconductor companies that are catering to more of the industrial end market and less so AI, or even if they're doing AI, like Marvel Technology, you know, their AI data center business is fine and doing great, but the industrial business, the automotive business, their other non-AI compute business is rather lackluster, and their stock got hammered when they reported Q2 earnings. So I don't know if it's necessarily pulling, but yeah, it's sucking up a lot of capital within the room. And again, it's there was a Bain report. I'm sure people watching this saw that they estimate that through 2030, there's a need for $2 trillion of revenue to finance all the spend. And according to their forecast, we're going to be $800 billion short of that. So there's no debating, the current demand, but we have to ask ourselves, like, is this spend right now in this build out based on forecasts for what these companies perceive as demand, or they're doing it because other people are doing it and they don't want to lose? Like, are we going to look back in this and say this was an ego thing, that, well, if Sam Altman is spending all this money and I'm Elon Musk, well, I need to spend that money, and Zuckerberg needs to spend that money, and Google needs to spend it, and they're all spending because they see what other people are spending, and everybody does. No one wants to lose this race, so they'd rather spend more now to make sure that they're not left behind. And when you start approaching things like that, then you inevitably will overbuild, because someone's going to push this too far because they don't want to lose because of the ego thing, in a sense. Yeah. So I know how this is going to end, but saying when it will. But at the end of the day, when it ends will be bad for them, but it can be good for the rest of us, because we are going to integrate this technology into our daily lives, whether at the household level or the business level. And if the cost of utilizing this compute from a user perspective collapses because of all the excess capacity, well, maybe that'll be good for other parts of the economy. But the internet was great for the economy, and low cost access to fiber optic cables to send streaming services was great for the user, but it was really bad for the people that were putting those fiber optics into the ground. So there's going to be a lot of capital that's destroyed at the end of the day. There's no doubt. But then they're going to be beneficiaries of that for sure. But like I said earlier, the economy and the markets are all in on the data center build out, not necessarily the usage of the Gen AI. It's the data center build out that's sucking up all this capital and turning these beautiful large cap tech stocks that were once free cash flow machines into these extraordinarily capital intensive businesses that should alter their valuations going forward, but certainly hasn't happened just yet. The market is valuing them like they were when they were a asset light business. They are no longer that, but they haven't been re-rated yet, which they will at some point. I just don't know when.
That's a really, really good point. And I hope everybody sort of locked onto that, like, is your high flying tech now sort of turning into some sort of utility or industrial because they sort of own these energy data center hard assets.
And while I'm on this theme, and it's not something that I don't think many people are focused on. It's like we had that DeepSeek news at the end of January, and we obviously had the big response. I think NVIDIA was down 17% one day, but today that's pretty much been forgotten. Mm-hmm. But I beg people not to forget it, because since that news, DeepSeek's model's only gotten better. Alibaba has a model, Baidu has a model, Tencent has a model. The competition that US technology companies are going to face over the next 5 to 10 years, and not just Gen AI, but semiconductors and Huawei, which will be soon having their Ascend chip that can be just as good as, or almost just as good as NVIDIA. The competition coming from China over the next 5 to 10 years will be the greatest competitive threat that US technology companies have ever faced. And that matters for both the ability of US companies to sell technology into China as a customer, but also to compete for other customers around the world against China. And that if you are that German company that is building out something, and you have access to Chinese technology and US technology, and Chinese technology is offered at a cheaper price, China is going to be a real competitive threat. Now, this is something that's evolutionary. It's going to play out over the coming years. But the US technology is not going to dominate like they once did. US technology is incredible. We are the leaders in innovation for sure. But innovation now is becoming a key part of China technology right now. It's not just copying. And all you have to do is look at their EV sector. It was the Ford CEO that went there a year ago and brought back, I think it was a BYD, or it was one of the Chinese EV cars. And he was blown away by the technology and the capabilities of that car. And he repeated the competitive threat on Monday in a podcast that he did. This is, again, the CEO of Ford, about how Tesla and Ford and GM just cannot compete right now against China EV. So I think people need to incorporate this new reality when they look out over the next 5 years, and go buy NVIDIA, fine, and go buy some of these other hyperscalers, fine, and this, but don't underestimate the growing competitive rivalry on a commercial basis that we have with a lot of these Chinese companies.
Do you like China as an investment theme? Because, one of the things that has helped China is their ability to plan for the long term from a capital perspective, not worry about those short-term revenues. Has not really been that kind of shareholder mentality. It's more sort of, nation craft. Does that make them, is there an investment trade there, or do you have to stay away from it because of the politics around it?
So my trade of 2024, not 25, 2024, coming into the year, was the Hang Seng was going to outperform the S&P. The market got so ridiculously cheap, and everyone was saying China's market was uninvestable, and everything was getting thrown out. And I said, the Hang Seng is about to have a big year. Now, the S&P actually outperformed the S&P last year, but if you look at the Hang Seng from the beginning of 2024 to today, it's crushed the U.S. markets. So we've been long Chinese stocks for almost 2 years now. Plus, we had owned it coming into 2024, so we were suffering a bit, no doubt about it. But held on and added in a bunch of different areas. Now, in certain parts of the Chinese economy, you got to be real careful. I mean, the competition is squeezing profits out the door for sure, particularly in EVs. But you look at the valuation of BYD, it is a microscopic compared to Tesla, and I'd be buying BYD hand over fist relative to Tesla and other auto companies. But there are other areas of the Chinese economy where it's not as competitive. I mean, the Macau casino stocks have essentially been given licenses, 6 licenses. So that is a completely different world than the competitive world in EVs, where you're basically been granted one of 6 monopolies. So there are ways of avoiding some of that intense competition, where my friend Louis Gov likes to say is a Chinese company, enters your business and the profits will disappear out the back door.
Yeah, it is not a level playing field. Hard to compete on that. That we had a bunch of chat about Tesla too, so I'm sure you're all eating that up. I want to ask this question. We got a couple different questions coming in. I want to ask this one, and this is from Steven. I'm constantly reading that passive flows are dominating market action, yet stock to stock correlations are at historic lows. That makes no sense to me. Any thoughts?
I mean, the passive is continuing. You know, when the money comes into the market, it mostly goes to the biggest names. I mean, the top 10 stocks in the S&P we know are 40% of the index. So that $1 passive, 40 cents of it goes to 10 stocks. So you can get a lot of dispersion on the other 60 cents. But the passive in, and when this market turns, and it will, I just don't know when it does turn the other way, the passive flow in is going to be the passive flow out, because a lot of that passive flow in are baby boomers.
Mm-hmm.
And you can be sure when you get to that age, you don't have the tolerance for sitting around another bear market. So yeah, the passive flows works as long as it does. And then when it reverses, it's going to be a lot of people rushing out a very narrow door.
Yeah, that's something that I think worries a lot of us when you look at put the demographic lay on top of that. It's something Mike Green's talked about a lot too. It could start to happen regardless of what the market's doing, just because those people need that money to live on.
And if you get a further slowdown in the labor market and people start losing their jobs, they get less paychecks, there's less 401k money going into the markets.
Which is a really, really good point. And I think underreported and not spoken about nearly enough. I mean, if you look at the labor market data that has been coming through, youth unemployment is really high. And when you look at AI, Juliette DeClercq and I talked about this. If you haven't looked at that interview, please go do so. When you look at AI, those are the jobs that are most likely to get eaten up in the early phase, is that sort of fresh out of college, young worker, knowledge worker. She's super concerned about that demographic. Not only what it means economically, what it means, politically and society, from a society point of view, but they're also not going to be contributing. They're not going to have jobs, at least in the US, the way our system is based, to be feeding into any kind of early 401. So that's a real worry about where those new flows are going to come from.
Yeah, it's something to watch. I mean, I still want to be optimistic that technology will always create new incremental jobs. There's no doubt there are going to be a lot of displacements with what's going on. I still think it's a little too early to know. There's an example that I read about when you take sort of a call center. There was this belief that Gen AI was going to replace all these call center people, and what was quickly realized is a person needing help wants to speak to a person. I mean, just you can run a video of someone on the phone saying, give me a representative, because they're frustrated and pissed about hearing from some agentic voice.
Yeah.
So what they found is that call center person is answering the phone and using themselves, AI, to answer the questions of the person needing help. And it's actually empowering that person to better do their job and better help that person that's calling for help. So I don't want to be dismissive of the changes that are going to take place with this, but I think those that says, we're going to wipe out all the, half the jobs of white collar workers or whatever, I think it's going to be much more nuanced. And rather than being dramatic with people's commentary about the displacements, let's just see how this plays out, because maybe Gen AI actually helps people do a better job of what they're doing rather than replacing them.
Yeah, I'd like to be optimistic too. I think what worries me is I don't think anyone's sort of discussing this enough, certainly not from a policy point of view, but that should come as no surprise. I mean, here we are with the government shutdown, when these are very big issues looming, and it would be fantastic to have some very smart people who are actually doing a lot of thinking about this, and they are out there. Many of them are on Substack, actually sort of like getting together with policymakers and trying to get a handle on this before we're smacked in the face with it. That's, I think, what worries me, is more of the sort of planning and response and the actual technology. This is a little bit of a niche question, but I'm going to put it up anyway, because obviously Ian follows you. Are you still in the Man United trade?
Yes, I am. And happily, not happily from a stock perspective, but from a valuation perspective. Man U still trading at around an enterprise value of $3 billion, which is probably less than half of what it's worth, particularly when you see where these NFL deals are getting priced at. Man U got hit a few weeks ago after the reported earnings. Revenues are pretty solid, and actually they really narrowed their losses, but their EBITDA guidance was a little light. But I want to see them narrowing their losses, and that's exactly what they did. I think the problem is their performance on the pitch, on the field. For those that don't know that lingo, they lost again on Saturday. I was watching the game, but that's when you want to buy a sports team, is when the team is bad and the team is not good, and that's when I think is the best time to buy it. So I'm still long it. I think Jim Ratcliffe has been a welcome addition to shaking up both the team from a performance level, but also from a corporate level, and that he's cleaned house. They had way too many employees, and I think that the Glazers just really didn't pay attention to running an efficient situation, and Ratcliffe is bringing that to the team. We're still awaiting details on the financing of the new stadium, which unfortunately is still going to take many years to play out. But once that thing is done, it's going to be amazing. But still waiting to see how it's going to be financed and when those shovels are going to hit the ground.
Amazing that we'd be in a time when Man U wasn't doing well on the pitch. For those who remember, I mean, it was a dynasty for so long. So that's so crazy.
I mean, if you had the chance to buy the Yankees at a depressed valuation, would you?
Yeah.
I would say everyone would raise their hand. And I think Man U was a very similar, scenario.
Yeah. I'm so interested in the whole investing in sports, because it's like obviously a place where we know people gather, and even though they're using AI in recruiting, it's one thing people want to watch. They want to come together for the live aspect of it is really important.
And I know Gen AI is not going to replace that.
Yeah.
People are not going to go see, I've seen some of the videos of robots kicking a soccer ball and robot boxing I've seen. But I still think at the end of the day, people want to see people competing.
Well, it's the sort of one last mystery out there sometimes, right? I mean, if I've been listening to my family's fantasy club, and no one's getting it right, because it's been crazy. I mean, it's been crazy, some of the results. So that's wonderful, right? That even the betting platforms don't always get it right. MK asking, do you think long-term rates will rise if the government shutdown continues for several weeks? Like if this thing starts to really, especially around the holidays, going to screw up traffic, people are going to really, and travel, people get really angry. Does it start to have an impact or no?
I don't think any lasting one. I think long rates go up, but it's not predicated on the consequences of a government shutdown. It's more related to, I believe we're in a sovereign bond bear market. I think long-term interest rates over the coming years will continue to head higher. I think in the short term, for long-term interest rates, what the BOJ does at the end of October with interest rates is going to be more relevant for long-term U.S. interest rates than the shutdown. There was what historically has been a dovish BOJ member that actually sounded pretty hawkish a couple of days ago. So we saw the 2-year JGB yield as of Monday's close rise to the highest level since 2008. To me, that's really important, because I think that rate hike could be followed by another one in December. I think that's what bond investors should be focused on. And I understand right now the push and pull between lower rates because of worries about the economy and the labor market, and the thought that maybe inflation is topping out. But on the other hand, debts and deficits and expressing their concerns through the bond market, what the BOJ does, and we're sort of all somewhat correlated on the long end. And if the economy does roll over in the U.S., well, that could lead to a budget deficit that instead of 6.5% to 7% of GDP, that can be 10 to 12% of GDP, where you can actually see a rise in long-term interest rates with the U.S. recession. So again, pushes and pulls, but I think long-term interest rates are going to stay elevated. I mean, the Fed has cut interest rates by 125 basis points since September 2024. And today, the 10-year yield at 4.10 compares to about 4.10, 4.20 12 months ago. So you basically haven't seen much of a decline in long-term interest rates, even with 125 basis points of rate cuts. And that 10-year yield is off the 360 low that it was a year ago, and when it was falling going into that first hike. So here we are, 50 basis points higher, even though the short end is 125 basis points lower.
And yet just a short time ago, before we came on, President Trump tweeted, "I really believe that Jerome Too Late Powell is an obstructionist," all in capital letters. Certainly Scott Bessent must know why yields are not going down and some of the pressures that are actually there. Do we continue to see the sort of government takeover of the Fed or political pressure to push those rates lower? And does that exacerbate the move higher? Does it actually have the unintended consequence of pushing yields higher?
If Trump wants to see the 10-year Treasury go right to 5%, he can have his next Fed chair cut rates to 1% to 2% today. Go ahead, cut rates to 2% today, and you will see a 5% 10-year yield on the same day. Make your choice. What do you want?
That's yeah. We'll see what happens. Someone presumably is telling him that, but I'm not sure he wants to hear the complicated answer. Peter, it's always so fantastic to catch up with you. I appreciate all the detail you do in your work. It always helps inform me, and it's always lovely to see you.
Thank you, Maggie. You as well.
Thanks so much. Thanks to all of you. We will see you again on Friday for our residency with Dale. In the meantime, take care and good luck out there.